Oh, now I'm going to give it back to him. Matthew is so funny. He apologized earlier for introducing me in the marketing session as infamous, and I told him that we could just settle on world famous, or as the Virginia lawyers that I worked for who kept calling me ma'am, we settled on Her Majesty. So either of those will work fine. We've got a great turnout here today, but I must say it is not as good as the last turnout that we had on a panel. So the only thing I can deduct from that is that the people in this group are more interested in marijuana than they are in financing. Who knew? Who knew? So the program committee will definitely take that into account for future programs and see what other kind of controversial topics we can bring out. Lindy can be a little boring in that respect when you're comparing it to some of those other things. We have a great panel of professionals today, and all kidding aside, we want to talk about what's new in financing, get ideas from them on how we can do a better job at financing, and what boxes you must fill in order to qualify for what they have to offer. I had two panel members who shall remain unnamed that said, Connie, take it easy on me. And I didn't understand how they could even think I would do anything other than that. So this is going to be a fun, open dialogue. If you have questions as we go, please ask them. If you have questions at the end, please make this an open dialogue and make this as beneficial to you as you possibly can. So I'm going to start with some introductions. Actually, I'm going to say names, and I'm going to let people introduce themselves. I don't think anyone needs an introduction for Jess Richardson, but Jess, go ahead and tell the group who you are and just a quick what you do.
My elevator speech. I'm Jess Richardson. I work for Wells Fargo. Can you hear me all right? Do I need the mic? There. Is that better? Okay. Jess Richardson, work for Wells Fargo. I have been a member of CCIM for over 20 years and have gotten a lot of business out of this group over the last 20 plus years. I've worked for several different lenders, and one of the things that I have found is that the relationships that I have developed in this group really follow me to wherever I go. It doesn't matter. It's the people and the relationships that I've developed here that stay with you no matter where you work. I currently work for Wells Fargo. It's a great place to work. They do SBA lending, and that is my area of expertise.
Steve Wilshire, I learned in the last meeting. Okay, go ahead.
Oh, yeah. My name is Steve Wilshire. I own a company called AMF Capital. We're a mortgage facilitator, broker, if you will, in Portland, located in Portland here. Predominantly working with all the 4 food groups as far as product is concerned. Market-wise, we focus a lot on the Pacific Northwest states as well as national, depending on the product type. We do quite a bit of single-tenant net lease, commercial product, industrial, etc. Been in the business for several years. AMF Capital was originally started back in 2004, and then we had a brief hiatus with another firm for a few years, and then came back full force with the company. We've been steadily growing, expanding a bit, and continually looking for other players as well to bring in. Again, pretty strong dynamic when it comes to certain products. As a company, we focus predominantly on the underwriting prospects of it as the deliverability of the project as opposed to quoting a product. We'd rather make sure we're delivering it, and we take that stance when we look at the product. So as we go through a project with just about anybody, there's a lot of questions, a lot of answers that we're looking for, all with a focus of delivering at the end of the day. So.
Okay, Darcy Nordby.
Darcy Nordby, Banner Bank. We do all types of commercial real estate loans, basically investor, owner-occupied. We'll do the gas stations, the hospitality. Hospitality, we are a little limited because we do like the branded. But we will do SBA loans, not to the extent that Jess will. And really, we really work on relationships. We try not to do just one-off transactions. We try to keep in touch and just make it a continuing relationship.
And Isaac Grant.
Good afternoon, Isaac Grant with Northwest Community Credit Union. Appreciate the opportunity to be here on the panel today. Northwest Community Credit Union has been serving the Oregon area based out of Eugene, Oregon since 1949. When 6 Weyerhaeuser login employees put $50 in a lunchbox and started a credit union for the wood products industry. Now we serve close to 90,000 members across the entire state of Oregon, from Portland down to Medford and central eastern Oregon over to the coast. I do have an accent. I am not from the local area, so I always like to get that out of the way first. Also, no, a little further than that. I am from the south, but the south of England. It's not Australian. I don't know why that's the #1 guess. Also, apologies, I do have my phone out on the table. My wife is in the last trimester of pregnancy with our 3rd child, so if that goes off and I exit stage right, it's because of that. So.
Well, thank you all. And so when we put this together, we tried to pull together a group of different kinds of lenders and brokers so that you could get a number of perspectives. And David and I came up with 5 questions that we had that we thought would be interesting to have them respond to. And then they provided some questions to us so that we're getting the information from them of what's out in the market. So our first question is, Craig. Craig was napping. We caught him napping. In this new world of financing, besides equity, we all know that much more equity is required now than typically ever before. What's the most critical element? So, Steve, why don't you get started on that one?
Equity is always a factor. What we predominantly see most of is liquidity requirements, net worth requirements. A lot of the changing demographics of the marketplace today have taken place because of failures in the market in the past, and a lot of it has to do with the lack of liquidity with your sponsorship. So a good part of focus today is really the financial strength of your sponsors, understanding where that, I think they speak a lot of cash flow, which they'll talk about, but cash flow certainly is a factor for a lot of owner-occupied. Investor products that we typically deal with, we are focused on liquidity. Unrestricted liquidity is a term you'll hear quite a bit, which relates to predominantly cash. Restricted liquidity assets, such as IRAs and 401ks, people tend to look at. They are a little different, treated a little bit differently in the marketplace today in some of the products that we deal with, but liquidity is probably your biggest factor. So understanding that dynamic, where it's coming from, how solid it is, and what likelihood it'll be there post-closing is a big consideration for the marketplace. I think that goes across all lending platforms for virtually all product groups today.
Jess, why don't you add in there?
Yep, thank you. SBA lending, for those of you who have never done an SBA loan, is a different analysis than we hear them talk about and hear about cap rates and all this other stuff. SBA lending focuses on the business's ability to repay the debt. And if they can repay the debt from cash flow, you know, we're going to be almost home. I mean, it really is. And that's why, you know, we'll do 90, 95%, sometimes 100% financing on a building. So the difference between what I do and what some of the other lenders are is that, you know, that's really our focus. If you can pay us back, you know, you're going to get the deal.
Jess, what about the financial stability of the borrower and down payment? How do you guys view that?
We look at all that. I mean, we do a global cash flow analysis, make sure that he has enough income coming out of the business to service his personal needs and his family's needs. You know, we look at the debt to worth picture, and you know, make sure that there's some ongoing thing. That, you know, when I'm talking about an owner user purchase for real estate, I mean someone that's been in business for a while and they either want a rent replacement deal or they want to grow their business. So that's, you know, with that in mind, most of those businesses have historical debt service.
Darcy?
Well, you know, with us, it's really the ability to repay the loan is our #1. And we will look at it 2 different ways. We look at it from cash flow from an investor's building, but we also will look at it from the global cash flow. So if someone is purchasing a new building and it's been mismanaged, we will take into consideration that under the new management and the borrower's overall ability to repay, that we will consider that also.
Great. Isaac?
Yeah, I think very similar. You're going to kind of hear some similar answers from all of us, I think, but cash really is the most the most important component right now is what is the ability of that borrower and the guarantors to be able to service the debt that they're taking out. We've done a lot of investor real estate, so unlike Jess doing a lot of owner-occupied, we do quite a lot of more passive investment deals, so we want to take a look at how much cash is all of the income sources. So again, we've talked about global cash flow. I think we'll probably hit on that a little more later, but yeah, making sure that borrowers and guarantors have enough cash to be able to service the debt that they're taking on is a huge component.
Great. Okay, question 2 was something I was very interested in because I'm seeing this so much in my practice, but none of the lenders on the panel seem to think it's affecting them that much. Scott, from my perspective, commercial lending is being greatly aided by the Jobs Act and the ability to raise equity through a private placement. Are you seeing that come into play? Yes. Come into play much?
We don't, as a company, we're much of a facilitator. When we're looking at a project, we're exploring all the components to that project as a whole, the sponsorship, the property, the asset location, market quality, on and on and on. When we're looking at the sponsor, and I think that's where the Jobs Act comes in a little bit more. If you're not familiar with Jobs Act, it's basically an acronym for Jumpstart a Business. And it's relative to the crowdfunding environment. I think everybody's kind of heard the crowdfunding buzzword. When you're getting a pool of players together, most lending institutions today don't like to throw 15, 20 people on a guarantor line. And it's not so much everybody, I'd love to have all that guarantee money, but I don't think anybody, quite frankly, wants to spend the time to underwrite the individual, the entity, whoever it might be. Much like your clients and yourselves look at ROIs, return on investments, in our business we look at return on investment as well. How much time can you really put into that project and what benefit is there for everybody? When you're bringing in a group of investors that may have a 1%, 2%, 3% ownership interest in an entity, we don't really want to underwrite them. So as an institution, we kind of limit the top tier underwriting, and we do that because that's the lending platform as a whole, whether you're dealing with CMBS or you're dealing with life companies, you're dealing with retail banks or investment banks. You're looking at what what they're going to look at for the guarantor sponsor, who's going to back that deal up, as was said earlier, who's going to have the wherewithal to pay for that transaction. When you bring in the top 20% or top players that have 20% ownership or greater, I think is kind of the general term in the business, those are who you're focused on. You don't really want to bring in the 20 or 30 people that are 2% and 3% owners or 1% owners. The tenant in common structure, as once was the TIC environment, has kind of gone away. Crowdfunding, in our opinion, is very similar to that. But it's the new buzzwords today, and we just don't see a lot of it really affecting it because we don't really get into underwriting all of those individuals.
Anybody else on the panel want to speak to the topic? Are you seeing it? Have you done a deal where the equity was raised through a 506 offering? Wow, interesting.
Yeah,
okay.
I think a big part of it is when you're starting up a business, you see that a lot more with the business startups, as everybody's trying to pool their money together to bring a product to market, bring a business to market, which happens to maybe be a concept, an idea, a technological product. And everybody's wanting to throw their money in the deal to reap the benefit if it does go public, if it does expand. So since we deal predominantly in investor platforms where these folks work a lot with owner-occupied, we don't see a lot of that participating in the investor side. So,
Isaac?
Yeah, I think that's a great point. I think maybe one of the reasons we don't have a lot of experience on the Jobs Act is exactly that. It's more geared towards business startups. We all have to lend on historical data, so we're usually using a number of years worth of tax returns to prove that money is actually being made, income's being generated to be able to underwrite deals. So that's probably one of the main reasons is that business startup lending is really just a difficult realm to get into.
Well, what I'm finding in my experience in representing clients is that developers and buyers are beginning to use that format to bring together the equity. I'm working right now with a major developer in town that's about to embark on a new project, and he needs about $3 million equity. And so he is working with some platforms and to pull together that equity. Now that person, that developer, is going to be on the guarantee. He's not going to, yeah, and that's the key. And he's not going to, he's not going to ask any of the people to be on the guarantee. But that's how I think where there are a lot more equity requirements, people are going to do that more and more since that capital is much more easily available. Okay, so now this is the shameless promotion of their own businesses. This is a gratuitous question. I ask each of them to answer, what is your lending sweet spot? Now, I'm joking, of course, because each of you want to know what their lending sweet spot is as well. So just go down the row and tell us about that.
Go right ahead.
Go ahead.
Thank you. Well, not that I haven't said it already, but SBA lending is our sweet spot. If I were to pick a particular type of deal that I like and it's the easiest to do for me, it's a rent replacement deal where somebody's been leasing a building for a lot of years and they get an opportunity to buy that building. That's a really easy deal for me to do and quick. So that's it. But there's two types of lending that we do in SBA. One of them is called the 7A loan program, and the other one's a 504. One of my partners that I do and I use often is Lachelle Carrick, who with Evergreen, she and I have done a number of 504 loans together. So,
Lending sweet spot. Are you asking about dollar amount?
Whatever you want to tell us.
Anything that we can deliver. Basically, from a dollar standpoint, in our side and more or less the wholesale concept is that we don't really have a limitation. The industry for us typically starts about $500,000. As a company, we tend to focus our minimum around $1 million and go up from there. Depending on the platform, they have limitations. Typically, as a company, we advertise up to $35 million. Although we've done larger recently, but from our standpoint, we feel that we're the strongest at that $35 million mark and under. Most of what we see today is anywhere between $2 and $20 million has been pretty consistent. We have a few of those going now, and several $5-6 million transactions going. So it really depends on the project and the platform they're trying to get at. If you're looking at CMBS platforms, the Wall Street guys, you get a lot more activity at $5 million and up with them versus coming in at $1 million or $2 million type platforms. So as far as sweet spots, again, most everything that we're doing right now is somewhere between 2 and 20, and the gamut in between. So.
Our sweet spot, I would say, is anywhere between 1 and 12 million. 1 and 3, we can actually underwrite in our own office, and it can be signed fairly quickly. But 3 and over is better pricing, between 3 and 12. And 12 million and under, we still only need 2 signatures, so we're still can deliver pretty quickly. Once we get to 12, we do go to loan committee, which consists of 6 people. So we could still deliver it quicker than a large bank. However, you do get a few more opinions when it gets to the underwriting table. But other than that, we can go up to 30. Over 30, we do start looking for participations with other banks.
Darcy, any particular product? I mean, do you have preferences?
We don't differentiate at all between owner-occupied and non-owner, which is different for a bank. We pretty much are the same across the board on all product types. And we do consider special purpose to be gas stations and hospitality, bowling alleys. But other than that, we pretty much stay between the 70 and 75% loan to value on most of our properties.
Thanks.
Yeah, the credit union, I'd say our sweet spot's between about 500,000 and 5 million. 5 million is our cap based on simply our asset size. We are more of a collateral-based lender than an asset-based lender. A lot of banks will be able to do asset lines based on the asset size of a business. We're more of a collateral value real estate specific lender. We do some asset-based lending, but our products simply aren't quite where we'd like them to be, and that's due to some of the regulations we have imposed on us by the NCUA. We've been extremely successful with multi-family residential deals. We've got a good standing history with that, but yeah, I'd say between the 1 million to 4 million is where we've really been successful.
And let's stay with you, Isaac, and let's go to what I think is the most interesting question, and I hope you guys have some good meaty stories to tell here, because this is the war story question. What's the most creative solution you have implemented in the last few years?
We've found a lot of success using Business Oregon, the Oregon Business Development Department, and in particular their Credit Enhancement Fund program. If you don't know what the Credit Enhancement Fund program is, it's similar to SBA type lending, where the borrower only has to come in with 10% cash down. So it's worked really well for owner-occupied and operational businesses that want to keep more cash if they're going to be doing some improvements to the property, and they want to keep that cash liquid so that they're able to expand. The way the Credit Enhancement Fund works is the financial institution actually lends the 90%, and then the borrower purchases an insurance premium through Business Oregon to shore up the whatever shortfall in the loan to value the financial institution puts in there. So for us, usually we like to be at 75%. So the Credit Enhancement Fund is going to shore up that 15% shortfall when the borrower is only bringing 10% cash down to the table. We implemented this actually for a large plumbing outfit based out of Lane County. On a side note, if you're ever going to do any type of business with plumbers and you take them to a baseball game, they will drink you under the table. Your tab expense will be horrific. Just FYI, if you didn't know that. So we've had these plumbers, they're longtime members with us, fantastic individuals. They were looking to expand. They were leasing space, had been leasing space for a long time, and their main motivation actually was for tax purposes, to be able to have some interest write-off. So they wanted to own their own space, be able to expand, create some more jobs, really set a market down in the community. So they actually negotiated with the seller to get a holdback of some funds to do some improvements, but they wanted to keep their own cash liquid as well. I'd say the main hurdle in that deal was actually the fact that our borrower was using a residential broker to do this deal, and it was slightly complex. She'd never heard of the Credit Enhancement Fund. So that was probably the most interesting part, was having to coach our client's broker kind of through the deal. But yeah, it's a great program. Unfortunately, I don't know how long it's going to be around for all business types. I know posted on their website recently, this program is available through June 30th, so we only really have this month left to utilize this for all business types. They've been a little bit vague on who it is going to be available for after June the 30th, so I'm waiting to hear from my contacts up there at Business Oregon as to what businesses, if any, are going to be able to use the Credit Enhancement Fund after June 30th of this year.
Isaac, that's a great tip, and I think people need to remember that. Do you know are there specific criteria, like is there job creation that's associated with it or anything like that?
So there is job creation associated with that. I think this was going to create 6 new jobs, and again, that's based on the size of the company as to how many jobs they want to see created. I think they are a little lenient on that. They want to be able to get the deals done. So I think it was only going to be 2 jobs in the first 12 months, 6 jobs over the next 5 years was kind of their expansion plan. But yeah, it was a great program to be able to use.
Darcy, go ahead.
I would say for us, it's probably our ability that we don't have to match the loan term to the lease, which is fairly common with the larger banks. Right now I'm looking at a deal. It's a pretty good sized deal. It's a credit tenant. The lease is up in 3 years, but we're still doing a 10-year term because that's what the borrower's requesting. And we feel that the borrower will probably renew, but if they don't, we still have enough I don't know, we believe that borrower can handle the building even with a new tenant. So I would say that's probably one of our most aggressive approaches.
Steve?
Well, as a company, you know, AMF really looks to, we partner as opposed to compete with lending institutions. You know, we're looking at banks and credit unions and agencies and commercial industrial investment banks as partners for us. So when we talk about creativity, the creativity I used to do 10 years ago isn't really there today. Most of it's illegal, but
It probably was then too, Steve.
probably was then too. But we delivered.
Yeah.
So you know, I think the industry dictates quite a bit of how much creativity you can actually get to. You know, we're involved with a project now. It's 100% financing of the acquisition with some escrow holdbacks. We closed a project here downtown Portland recently where the client utilized the PDC funds. It's a 7-story building, was vacant. Beautiful, gorgeous building, but utilized some PDC attributes to facilitate what he was trying to accomplish. We provided him a loan with about a $3.5 million holdback for improvements, and then are carrying that for about 2 years to give him time to develop and build out the TIs. I think the industry, again, will dictate a lot of what kind of creativity can come into play as long as the fundamentals are strong, as long as the individuals who you're backing or guaranteeing a loan financially can withstand that property or payment, no matter what happens relative to leases or you know, the ongoing business concerns. So for us, it's probably 100% financing, escrow holdbacks. You know, we get involved with some of the folks with tax credits, new market tax credits, as well as low-income housing tax credits, which is kind of outside this market a bit, more multifamily. But again, just the project will dictate how creative we can get.
Jess?
So I got a call from a guy one day, and he says, I just talked.
How that story starts out.
Isn't that?
We need Jesse to have a great story.
To talk to a guy called me, and he said, you know, I've been renting this building that I'm in right now for about 10 years. The landlord has never wanted to sell it up until right now. He said he wants, you know, $2.5 million for it, and I don't have the 10% down. That's what the requirement is for SBA lending. He said, I wish I'd known that he was going to sell me the building, because just last year I put about $250,000 into improvements into this guy's building. Well, we were able to write the contract in a way that the seller gave him credit for that $250,000 that he'd put into the building by acknowledging that it increased the value of his building. We were able to use that money as his down payment. So in a sense, he got to buy the building for $2.5 million, and we financed the entire project by giving him credit for money he'd spent a year ago. So, you know, there's a lot of creative things that we can do there's a lot of flexibility in the 7A program and with the 504 too. So anyway, that's my creative story.
And, you know, this is my favorite question, because my goal when I teach classes to this group or when I'm asking questions of you guys is to help the listeners think outside the box. How can we make this work? Doing crowdfunding or crowdsourcing, doing the CEF program, figuring out ways to bring money. One of my favorite stories about putting a deal together is a structure that I've used 3 times. 2 times on the no leverage side. That side's no fun. 1 time on the leverage side. And on the leverage side, you guys all know about Bridgeport, and you all know about the Village Inn. Okay, Village Inn was up on the hill, kind of behind the trees. They had that big orange sign, but Bruce Wood needed my client's property for transportation improvements in order to make that work, because that intersection had a grade F. So they had to take out that hill. They had to put the intersection in right there. And so I was representing the Village Inn, and we said, okay, you can have our property if you find us a new location. Now remember, I've already tested this on the no leverage side twice before this. You find us a new location that's acceptable to us. You build us a building that's acceptable to us. You move us at no cost, and we'll move, and you can have our place, right? Okay. And we don't want to have to pay any taxes. So this is this is a 1031 exchange, but you can't do all that in terms of the delayed 1031 exchange time. So you do an exchange, you have a lease that can't be broken after the contingencies are done, and you just kind of negotiate it through so that it's a turnkey for the person that's moving, and the desperate person gets the property that we want. We did that at Hawthorne Farm on the no leverage side. We did it another time, but there's ways to make it go together, and just get on the phone with the professionals and the people that you like and brainstorm. I mean, Jess will sit for an hour or more and talk to you about ways to make something happen, as I expect most of the people on this panel will. So that's the end of my questions, and then we posed a question to everyone on the panel, which is, what is your most asked question? Okay, so I want to go, I've got them right here, most asked questions. So I'm going to go through and I'm going to call upon them to talk about what people ask them, and then we're going to open it up and you can ask them. Not me, because I don't do extemporaneous well, so you'll have to ask them. Okay, so Steve, what's being financed today? What are the kinds of things that are coming to you?
As far as property types or
I don't know. It's your question.
Oh, those are those questions. I actually had to answer the ones that I just gave you questions.
You had to answer the questions you gave me. Sorry if I wasn't clear about that.
You know, what's being financed today? I think as an industry, everybody's looking for good quality assets first and foremost. That's the predominant question. What kind of quality is the asset? We get into quality of market, quality of sponsor, and so forth. I think, for the most part, as I say, everything's financeable in this business. It really is. A lot of it starts to come into play when you start putting qualifiers on it, and that's where the rubber meets the road. Is we can finance in just about any product, just about any market. The difficulty is at what leverage, at what structure, at what rate. So I think a lot of it has to do with what's the intention of the investor. What are they looking to accomplish? We tend to focus a lot on what their goals and objectives are first, and then marry the lending partners to that, where you might have 3 or 4 or 5 that will play. So when it does come into what is being financed, good quality assets, good market, good remarketability, good strong sponsorship structure, good leverage platforms. Again, that just depends on the deal. So everything can be financed. You just have to sit down, as Connie had suggested, sitting down and understanding what everybody's goal is and try and put all the pieces together.
And Steve, sticking with you, can you finance medical marijuana?
That's a very good question. We get that question still today quite a bit. And as Darcy and I were talking about, the difficulty is the institutions taking the deposits, the cash. Money laundering still isn't allowable in this country for some reason. But there are a few guys that will actually do loans on properties. You're typically dealing with hard money and that type of thing. But one of the things that we try and tell people is if your intention is to do that, it's really best to discuss it up front so you don't get caught. Lenders today will always go back and visit their property. If they're in their portfolio, they're going to look at it least once a year. You really don't want to create a problem for yourself in the future. We have had lenders that, as long as the lease tenant within that lease does not exceed a certain percentage of the overall gross square footage, they don't need to approve those leases. And there are lenders today that have a significant amount of those products in their portfolio. Their problem today is that they're not in default from a monetary standpoint. In a technical standpoint, they may not be in a technical default either if the square footage is lower than them to require their approval of the lease. So a lot of them are sitting back on their hands and waiting to see what the federal government's going to do. And obviously the states do what they want to do, but until the federal government steps in and says it's okay, there's still a lot of hedging on that standpoint. Lenders, if knowing about it going into it today, will not finance the property. Traditional lenders. Correct me if I'm wrong, guys, because if you're not, I'll be talking to you. But there are a lot of folks that are asking about it because it is such a large business. Leases are double market or excessive to market space. So from an investor standpoint, it makes great sense. When you can get $40 a square foot and the market's 16, it's really hard to walk away from it from an investor standpoint. But the challenge is what happens when. And we don't advise clients to take it on knowingly, because it's not a good move. You don't know what's going to happen. We have had people that have moved ahead and done it anyway. One of the cautions that we do is what type of business is actually being done. If it's a retail dispensary, that's one thing. If they're in growing, that's another. Now we have environmental concerns with mold, all the water. If they're processing that to another step, there's been a tremendous amount of explosions nationally in these buildings, and I can guarantee your insurance company, I'm not an insurance guy, talk to your insurance guy, but I would almost guarantee they will not guarantee to cover your expense if that's the reason it exploded your building. So just be aware of what your limitations are and are not. But our advice is not to do it knowingly, but we have had some lenders that will do it non-traditional. That is a question we're getting asked quite a bit.
Yeah, I'll bet. Is there anybody on the panel that's doing non-recourse loans? Darcy?
We will do them. Usually our loan to value is a little bit less. We try to stay 60% LTV and under, and we also like our borrower to be fairly strong. We don't want them, giving us all the cash they have and owning only one building. But as long as they're fairly strong, we will do it, especially in David's case with the IRA, because they really can't guarantee.
Isaac, talk to us about global cash flow.
Oh, yeah.
What
I was going to say we do non-recourse as well, but we're maybe a little bit more conservative on loan to value. We'll do 50%, and we like to see a 2-to-1 debt service ratio. But yeah, to get to the point on global cash flow, and I'm sure, feel free for anyone to chime in. Matthew was asking, what's changed in lending post-recession, and I think a more scrutinized look at global cash flow is one of the big components. It's basically looking at all forms of income, all sources of income from the borrowers and the guarantors that you have on your loan, and also, therefore, all of the debts. I think previously lenders would maybe look more property specific, so especially for us in more of a passive investor type situation, maybe that investor was feeding a bunch of failing properties with their W-2 income, but this new one looked great. So, just focusing in on the property-specific purchase, things look great, but maybe they were hurting in other areas and they were having to feed other properties. Now that's getting harder and harder to do. You may have a client who's, the property they're going to purchase looks great, but on their global income streams and their global debts, maybe they've leveraged a little bit too hard, which happened a lot just before the recession. People kind of leveraged their leverage, and we're all kind of hurting from that a little bit now. If you want to talk war stories, I think that would be something that we've all experienced. So yeah, we want to look at all the sources of income that we have to make sure that all the cash that we have coming in is able to serve all of the debt, not just the specific deal that we're looking at.
And stay there for just a minute. Tell us why a credit union rather than a regular bank. What's different, and how does that affect your borrowers?
So the main difference for us is that we are member-owned. We're not owned by shareholders. So our board of directors is all voluntary positions. They are not paid. They basically are there on a voluntary basis. When you become a member of the credit union, you now have a share in our organization. So every single person that has a share in our organization has a vote. They have a voice, and we try to make sure that as a result, our rates and our fees are therefore slightly less and more competitive, because we want to try and give back to our members. I guess the main difference is the way that we're structured as an organization is to try and focus more on the member and more on the people that are part of our organization.
Thank you. Jess, you gave me a list of questions. Why don't you, instead of me asking you, why don't you tell us what the most important question is that people ask you and answer it for us?
important? Well, I don't know. One of the questions that I get asked a lot is, you know, the building that I want to buy needs to be retrofitted and needs, you know, several thousands of dollars worth of improvements put in that. And what do I do about that? And you know, when we're looking at an SBA product, you're looking at the total project. So it's $1 million to buy the building and $500,000 to improve it. The borrower has to have 10% of that total, if you know, down, which is, you know, a question that, you know, a lot of people are surprised by. So that's one of the questions that get asked a lot. What was the other question?
No, I just asked you to tell us what it is. Okay, what time do we stop? 1:30? 1:30. Okay, so that gives us about 12, 13 minutes. I've got more questions that I can ask, but before I do that, I'd like to open it up to the group. So go ahead.
What question do you wish people would ask you that they don't?
That's a good one.
Well, that's a tough question to ask. I think, you know, a lot of time I wish they would ask what it does take to do a loan. Because, you know, as the market's changed, I think everybody is still, if they haven't done one for a while, is still kind of stuck back what we used to do. I never had to do that before. Why do I have to provide that today? I think as an industry, the platforms have gotten a lot more conservative. And therefore, we want to uncover a lot more layers. We want to look at a lot more items within the overall project. So I think I wish they would ask what it takes to get a loan done today. We try and advise them when we're going into it. You know, there's a laundry list today that is going to be needed. It may seem like a lot, but it really does provide a good picture of what's going on. Back in the day, you can sign a document, fog the mirror, you got a loan. Today, you know, we're trying to uncover and verify and document everything. So having them understand what it does take to do one today would help them a great deal, and I think would keep some prizes down quite a bit.
Anybody else want to address that?
Well, I can say that prior to the recession, when I did my own write-ups, it would take 5, 6, maybe seven pages to write up a $2 million commercial deal. That same deal today takes anywhere from 13 to 18, and it has attachments of spreadsheets. I mean, it really is unbelievable what we have to have, and primarily it's the regulators and what they come in and check us on.
Kevin?
We're seeing a lot of the municipalities are wanting to see a blending of different food groups together, whether it be retail, hotel, office combinations, and it's really hard to get the underwriting done on those because most of them like to stick with one food group, 2 at the max. Are you able to facilitate packaging deals that would allow for the multiple blending of food groups together?
Oh, sure, yeah. I think one of the first questions that we tend to ask any lending platform is what's their appetite? You know, what are they looking for? You'll find some lenders that institutions or lending types that maybe might be full in a particular product. We don't want any more retail. You know, multifamily is extremely strong. Everybody loves it. Everybody wants to buy it. Supply and demand is becoming a factor. Everybody wants to lend on it. You know, we still feel cap rates are you know, excessively low and continuing going that way. But at the end of the day, you know, that's a pretty strong product. Retail has had a large surge nationally as well as locally, but nationally predominantly in single tenant net lease, investment quality. We've got lenders that are saturated, you know, that want to keep under 50% of their portfolio in retail and expose other product to it. They're at 50% now, and they're looking at 40, 45 for the year. So there's a big demand for that from the client base, but lenders are starting to step back a little bit. They're pushing for industrial office, which office is actually getting a lot stronger, which we're happy to see. Fundamentals are getting stronger. The occupancy is coming up. So that's becoming a stronger product. Hotel hospitality, as she mentioned, flag product is certainly well sought after. Early in the recession, you couldn't get a Marriott done. You just couldn't do it. Today, flag product is certainly being sought after. And even some that are non-flagged. You know, if you've got a strong operator that's got multiple assets, different locations, strong financial numbers, those are certainly good products. And yeah, you can pool them. A lot of lenders will still look at that. As a company, see, we look at everything across the board. We have different lending institutions and non-recourse. You mentioned, we do a lot of non-recourse lending. It just depends on the product, depends on, again, the goal and the objective of your investor and what they want to try and do and what they're willing to do. So,
Matthew?
I've got a question I'd like to direct this to Darcy. Steve touched on this, and that is one thing that I've noticed in the lending environment today is that capacity and concentration is something a borrower should ask a lender. And Darcy, I think maybe you could elaborate on what I'm suggesting.
The way I guess we look at it is we have buckets. We have the C&I buckets and we have the real estate buckets, and they kind of have to stay equal for the capacity of any large bank. And the way we operate is, I think we figure it takes about 7 to 8 true commercial lenders to offset one of us real estate lenders, because it takes so many more equipment loans and unsecured lines and everything to offset when we can book a $10 million real estate loan. So that's what the banks are talking about with capacity and with real estate, and that's why some banks get so full so quickly.
Brian?
How are you handling borrowers that have had to go through a short sale or have lost a property to the bank if they're going to be refinancing or trying to acquire new properties?
I can take a stab at that quickly. It doesn't necessarily kill the deal entirely. It depends on the motivation behind the short sale. If it were financial gain, if it were for financial gain, and there's a few exclusions on that, then the answer is no. If it was a strategy, the answer is no. So sometimes those short sales happen because of unforeseen circumstances, and those often will be looked at. So
let me address that a little bit too, if I can. It depends on your question. Is going to depend upon how many sponsors you got in the project too. If it's a single source sponsor and that has affected the credit in a negative manner below a credit score that's acceptable in the industry, it's most likely going to be a challenge. If the credit score hasn't been affected profusely, there's still maybe a letter of explanation that might be sufficient for, depending on the lending platform. Another strategy would be if you've got multiple ownership structures, you still got an entity, but you've got one of the players that might have a challenge. We might suggest restructuring that operating agreement and dissecting that percentage of ownership or responsibility out of that player, and maybe create a separate contract on the side between them that has some liability exclusions. But there is a way to do it. Depends on how many players you've got in it.
Andy? Is it Andy?
So, Darcy and Isaac, a lot of applicants come in and they may know the loan to value on investment property, necessary loan to value. But how are you analyzing the debt service coverage ratios? Are you measuring those ongoing or just at underwriting?
I'm going to repeat the question for everybody.
Oh, you should have told me that before the question was. Would you like to stand up and repeat your question?
How are you analyzing the debt service coverage ratio, explaining that to your applicants, and are you measuring that ongoing?
Yes, we do up front, and on apartments right now with the low cap rates, a lot of times the loan to value isn't getting up to the 75% anymore because of the coverage. We do, it's kind of a sometimes. We can waive that annual, and I do try to, and it does depend on the loan amount, because I don't always want to dig that file out every year when they give us the tax returns and reanalyze it. So really, it's on a case-by-case basis.
Yeah, kind of a similar answer, I guess. The case-by-case basis cliche is kind of used, but I think the most important thing, like we've all said, we're in a relationship-based business, so we want to be upfront with those borrowers. So we don't want them to get to closing and see a debt service covenant in there that they've got to meet a debt service covenant on an annual basis that they were unaware of previously. But yeah, it's going to depend on the property type and again the cash flow and. But yeah, I mean we'll do it upfront and on an annual basis with a debt service covenant where necessary.
Okay, last question.
I'm probably the minority because I represent mostly Asian buyers and out of the country. Any lenders just lending to them? Because last year we bought 2 properties. My client did. They had assumption for one of the bigger banks. They won't let him assume any. My client actually has been in business in China, is manufacturing for 10 years with annual sales of about 30 million a year. But still nobody lended to him. So I don't know, is there any lender wants to lend to them? I know a lot of people think that they bring in cash. Yes, they could bring. He actually ending up paying all cash flow. But from my perspective, I think we could get it if we can get it leveraged. You know, his return is going to be higher than what he's getting. As a CCIM, I wanted to get him up. You know, his return to be higher than what he's getting.
So lending to Asian clients, that's the question?
Foreign nationals.
Foreign nationals. Okay.
I guess the answer is it depends. Yes, there are lending institutions that are regional, national platforms that will actually lend to foreign nationals, and generally do it on a non-recourse basis, which is what you're looking for. But also you have to look at how you're structuring. You know, we recently had a client in similar circumstance, Asian firm, very well financially healed, signing as a president of the corporation, but lenders will look to the guarantor beyond that. And you have to look at the size of the deal as well. Some lenders won't play in that platform under $2 million. So if we're looking at $100,000, $500,000, $900,000 transaction, your options are going to be very, very limited. You start getting beyond that, now you're getting into a lot larger scale where that's more acceptable from Canada to California. But if that fits the profile, then there are options out there for you, yes, and on a non-recourse basis. I did want to touch on non-recourse. Non-recourse is something that we do quite a bit of, but something that if you do have a client asking about non-recourse, you might suggest to them that they brush up on what non-recourse is today, because non-recourse has changed dramatically. It's the same term, but non-recourse used to be about a half a page of covenants that will trigger non-recourse. Now they're 2 pages long. So there's a lot, or 3. There's a lot more components where it might trigger that. So you guys asked about non-recourse, and there is quite a bit of it out there. But what we call the carve-outs, the bad boy carve-outs, that's where we experienced an issue with that particular individual where personally she needed to carve out a guarantor piece, and she was unable or unwilling to do that. As a president of a company, yes, but as a private individual, she couldn't do that. So that changed the dynamic of that project.
Thank you. Okay, so I have one. You knew I was going to have one wild card question that you're not prepared for, right?
There's never a wild card in this
So
business.
pretend that no one else is in the room, and you guys are on the phone. Yeah, go ahead and take the tie off, kick your shoes. You guys are on the phone with one of the other panel members. What are you brainstorming with them about? What are you asking them about that will help you in what you're doing?
It depends. That's the standard question. Yeah, it depends. Depends on the deal. We work a lot with the underwriting teams just to understand the strategies that that they're going to be looking at from their credit standpoint. Underwriters, when you're dealing with a salesperson relative to a financial institution, it goes past them to an underwriting manager, to a credit manager, and sometimes to committee. So understanding the dynamics of what your credit group is going to be looking at, I think, is probably extremely valuable. Talking with these guys and understanding what their credit administration has to see or wants to see is probably the biggest topic we have when we face challenges.
Okay. Anybody else? Okay. Matthew, it's yours. Thanks, everyone. Thanks very much to the panel members.